Hello, everybody. It is good to be back down on the floor here. Yes, this is the real pit behind me. This is live. Couple days, I was doing this remotely. So good to be here. Happy Friday to everybody. Been a heck of a week, been a heck of a month for September. Yes, we still have one more trading day until the end of the quarter, until the end of the month. But let me give you a quick review here, everybody, of what tradings has been like so far. So all of the major benchmarks, S&P, the Nasdaq, IWM or the Russell, okay, they're headed for the best September performance that we have seen in more than a decade. And that is after we know the rough start that we had the first few days of the month here and the typical seasonal weakness that we see in September, which typically, historically, is the worst performance month of the year. Okay, so they are all three, the S&P, the Nasdaq, and the Dow. Okay, they are on track. And again, we have the rest of today and we have Monday. They are on track for the best September for performance since 2013, 11 years. Okay, so far the Dow is up 2.3% for the month. That is the best since 2012. Now, the S&Ps, 2% for the month. That's the best since 2013. And the NASDAQ is up 2.7% for the month. Also its best since 2013. So just wanted to give you a little bit of a heads up of what's going on. Again, we have one more day plus today. So far, right now, we had just slipped into the red a little bit just over the last half an hour or so, right at the flat line now. S&Ps are literally at the flat line, but you know what? There's nothing going on. It did pick up just for a little bit a few minutes ago. Volume, though, across the board, incredibly light. S&P futures volume, 700,000 contracts. That is paltry. Qs, they're at about 25% of average daily volume right now. So, people were waiting. I was waiting. We all were waiting for the inflation data this morning, PCE data, which came out a little bit lighter than expected. And now that that's behind us, volatility is actually VIX up a little bit, but overall we're seeing volatility really crushed across the board. The next big piece of eco data next Friday. We'll get the September jobs report. Yes, it's first Friday of October. Hard to believe October is here already. Let me point out to you guys a few things that are really moving, though, in today's market. Some real big, unusual, uh, you know, option volume, if you will, that I have seen. The first one is in PDD. Okay, so I've got PDD up on the screen here, and we know what the Chinese stocks have done this week, given all of the stimulus, all of the news out of China. You can see this massive run up in what PDD has done. And today, there is just a massive, I know I keep using that word, massive amount of call buying today. In fact, let me change my screen over here to my Thinkorswim screen. Here we go. And let's pull up PDD and we can see what the actual option stats are for the day. Here we are. So a total of 417,000 contracts have traded today. That's already about triple the normal volume. But what you can see is call to put volume is well over 2 to 1. Well over 2 to 1. So, that is, I don't know if we should say that that is bullish order flow, but a lot of call buyers coming in. The second one I want to highlight today, MSTR. Okay, MSTR, which is really kind of a pure play on the crypto market, specifically on Bitcoin. Look at this, 315,000 contracts today so far. Again, about 2 to 1 call versus put. That is, I would say for this stock, more so than for PDD, that is pretty darn bullish. Now I'm going to bring up the charts here. If I can, there we go. I'm going to bring up the chart for MSTR. And look at this move. And this one is really, to me, I don't want to say exciting, but this one to me fits right in with one of the things we always look at, and that is the 200-day moving average. And look at literally, there's your August 5th right there, and we got a bounce, but then retested right there. And what a bounce off of the 200-day moving average there. So, you know, that is one of the really significant indicators that we look at. And now that I look back here, and a little bit harder to see, but if we go all the way back here, and this was, let me see, this was back all the way in January, almost touched the 200, and we saw a massive run up. Okay. MSTR, where can it go from here? Well, we're at some pretty significant resistance right now, right around this 182 area or so. If it can clear that, we probably get to new highs right around 200. So just wanted to show everybody that, because that is you know quite a significant bounce and very impressive coming off the 200-day moving average, especially with all this bullish order flow today. Okay, I want you guys, yeah, Gus, some would say contrarian. I definitely see that. A couple things. I want everybody to please post in the chat here two things. One, if you want to be involved in the spin the wheel at the end of the day for some swag, just put your name in there with me. Okay, and we'll get you in there. Number two, if there's something you want to talk about, a stock you want to look at, please, please let me know. Bob, great question. Am I attaching any concern to rumors of the second leg of the yen carry trade due to their election? No, not really at all. Not really at all. Okay, certainly something that is floating out there, Bob, and we kind of have to be. Oh, hello. Kind of have to be on top of that, but I'm not seeing real any signs that of any significance with that right now. Okay, good. A lot of you guys putting in me, 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 me. That's good. What just traded? The 5850 calls expiring Monday. So that's the end of the quarter. Looks like paper just sold 3,000 of those, and that's what was trading right behind me here. I'm watching the big screen up here, and hang on. Can everybody see the pit behind me? And actually, as I like to do when there's some business, pan the camera over here, okay, to one of the brokers over here, and I didn't quite hear what he's offering, but you can see that the market makers are pretty intently listening in instead of just kind of reading the newspaper. So there's something going on. If something trades, I will pan back over there. Tommy, how you doing, man? Okay. And also, by the way, just to give everybody a heads up, the VIX pit, which I always point out, it's kind of hard. It's like at about 1 o'clock where I'm pointing over here right now. The VIX pit is right there. I will be interviewed live from the VIX pit at 1:50 Central Time this afternoon. So make sure you tune in for that. Okay, want to talk about, and wow, looks like okay, paper just bought a December 5,047.50 put spread 5,000 times. Just giving you what's going on here. Okay, John, yeah, ping me in the room. Happy to give you the link to my Thinkorswim charts, okay? So ping me when we get back to the room. Okay, expected move, everybody. I got a lot of requests from people to review expected move, which is what I want to really focus on today. Talk about not just what it is, but why it is so critical. In fact, John, I don't know if you're the same, John, because we have a few in here. I know at the end of the day yesterday in one of the rooms, you threw out the question of, how do we select the strikes that we look to trade? And also the timing, meaning the expiration. And things are picking up here, guys. Hang on. There's that 5,047 put spread again. December, that paper's buying just went up another, look like 1,500 times here. Okay. Expected move. What is it, everybody? What is expected move? Okay, why is it so important? Why do we use it? Why does it help us determine optimally which strikes we want to trade? Okay, let me know in the chat. Let me know in the chat here. Okay, 1,500, looks like 1,000 more. 1,000 more of those just traded. And it's actually, guys, it's actually a 1 by 1.5. Very interesting. So, whoever the client is, the customer is buying 1,000 of the December 5,000 puts, and at the same time selling 1,500 of the 4,700 puts. Okay, Robert says the expected move is a target price to set the short strike. Okay, I agree with you. I agree with you. But why do we use it? Why is it significant? Why does that give us an advantage? Why do the probabilities work in our favor? This is the important thing about expected move. Okay, anybody else besides Robert? Okay, the expected move tells us at any given time, and obviously it fluctuates throughout the day, okay, depending on where stock price is, depending what volatility is doing, but it tells us at any point in time how much the market, how much the option market is pricing in a potential move in that stock up until that expiration. And as Robert and as Tom posted up in the chat here, it has a statistical probability. Whoa, that's not a good graph I'm trying to draw here. A statistical probability of 68%. Okay. Now, who knows what I just drew on the screen here? Okay. Besides just a nice squiggly line that with Halloween coming up maybe looks like it could be the outline of a ghost. Who knows what that is? Okay, yeah, that's the bell curve, one standard deviation. I know this might be boring to some of you, but I had so many people, asking about this. Okay, why is this important? Why is this critical? Well, if you remember going back to the days that we were in college, which seems like a long, long time ago, or maybe one of your kids, and the professor said, we're going to curve your grade. Okay, what did that mean? Well, what that meant is if you take this standard, what's called the bell curve, all of the data underneath the curve here, so from here to here, okay, that is 68% of all the outcomes, okay, in mathematics, in statistics, and I don't want to scare anybody here thinking that you may have to understand statistics to trade. But in statistics, 68% is the equivalent of what's called one standard deviation. Okay. Now, why is that so critical? Why is that so relevant to trading options? Does anybody know? It's easy to say, okay, I understand the bell curve and I understand the 68% or the one standard deviation, but why is that so important? And then why is it so important why we use it? We got to know both things. Okay, I'm going to wait here and I'd love to get some feedback here. So if anybody can let me know that, that would be awesome because I am going to go through it. I'm just sold. What is that? 500? Okay, that's nothing there. Okay, the reason it is so important is because the way that options are calculated, okay, the way that options are calculated using the Black-Scholes option pricing model, which is the standard model that everybody uses, okay, the mathematics that go into it use a 1 standard deviation probability. So when we get option pricing, 1 standard deviation is already priced in. So what does that actually mean? Well, let's take a look here. Let's actually look at one of the stocks I mentioned earlier. Let's look at MSTR. All right, let me blow this up on the screen here. And let's go out to, how about this October expiration? Okay, first thing we need to look at is where is the stock price? Okay, so we can see the stock price in MSTR right now is roughly 178. We're live in the market, so it's moving around. So to calculate the expected move, okay, what we want to do is look at those options that are closest to being at the money. At the money mean closest to where the stock is trading. Okay, so in this case, with stock trading 178.40, there happened to be 178 strike calls and puts. So if we look to see what the price of that call option is, what the price of that put option is, and we add those together, okay, we add those together, we get roughly 29 and a half. Does everybody see that? If you don't, let me know and I'll go through that again. But what we're doing is adding together both the call and the put price, which are closest to being at the money. Okay, so in this case, and we can do this with any expiration we want. Okay, any expiration we want. And what will happen is the further out we go in time, the higher that pricing or the higher that expected move is going to be. Okay, does everybody understand that? Does that make sense? So I just randomly chose October 18th here. We could choose any expiration. Okay, so once we look at that, we can say, okay, the market is pricing in a $29.50 move between now and that expiration, which in this case happens to be October 18th. Now, please keep in mind, this is so critical. Keep in mind, the expected move does not give us an indication of bullish, bearish. We've got to do our own research, okay? Our own research, to come up and look at technicals, whether we're bullish or bearish. But what it does is tell us how much the market is pricing in. This stock is likely to move between now and that expiration. So if we take, and now the stock is 177.50, that'll make it actually easy for the math purposes. If we take 177.50 plus or minus the 29 and a half, that gives us a downside of 148 and an upside of basically 207. Okay, everybody see how that works? All I did there was I took 170, I'll write this on the screen here, 177.50 plus or minus 29 and a half. Okay, that is now our expected range. Okay, 148 to 207. So if I was to redraw that bell curve, okay, hopefully get something good here. Okay, so we've got that. This would be your 148. That would be your 207. 68% probability, okay, one way or the other. Everybody understand that? Now, here is the key, and this is what Robert had said earlier, right on at this conversation. It tells us, or at least guides us, as to the short strike. Why the short strike? Well, remember, in any sort of option trade we make, regardless of the strategy, vertical spread, whether it's credit or debit, butterfly, diagonal, calendar, whatever it is, the optimal place for the stock to move is to the short strike at expiration, because the short strike is the option that we have sold, and we want that option to be as close to zero as possible, while the long option, the option we own, maxes out its value while that one is at a minimum. Does that make sense to everybody? That's why the target on the expected range, whether it's to the downside or to the upside, is what we look at to be our short strike. Okay, is that clear to everybody? Want to make sure, because that is so key. It's so important to understand that. S&P's still down about 9. They're down 9 now. Okay, great. So let's just look at an example here. Let's say for whatever reason you're bearish. Okay, and I'm just randomly, I'm not suggesting anything here. Let's just say you're bearish. Okay, what we want to look at, let's say you want to just buy a put spread. Okay, what we would look at is that 148. That would be the option that we would look to sell. Okay, so we can see right now that's trading, somewhere around 360, 365. What I would then do is look at what put should I buy that gives me really good reward to risk. Okay, really good reward to risk. Now that can be a, pretty questionable ask, or if you don't know, how do you know what your good reward to risk is? Well, at Prosper, in all of our rooms, we give a guideline to every student. To every student, okay, we have our cheat sheet as to what sort of reward to risk you should be looking for, whether it's based on a vertical spread, calendar, diagonal, butterfly, whatever it is. Okay? And the reward to risk, think of it as how much am I investing to get what sort of return? Typically if we were just looking at a vertical spread, like what I'm going to go through right now, okay, just a put spread here, we would be looking at something better than 2.5 to 1 reward to risk. Okay, if it's less than that, I don't want to trade it. There's not enough in it for me to take that position on. I'll find something else that offers me better reward to risk, better bang for my buck. Okay, so how do we calculate this? Well, if we know the option we're selling is roughly 360, let's just randomly kind of look here at the 154. The 154 is trading $5. Okay, so if I were to buy the 154, sell the 148 put, I could do that here for about $1.50. Does everybody see how I'm coming up with that? $5 on the 154 put, 3.5 or so on the 148 put. So my investment risk on that is $1.50. Give me a shout out in the chat if you understand. Okay. And also, because we're about 5 minutes away from spinning the wheel, if you haven't already put me in the chat, if you want to be part of the wheel here, make sure you get that in there now. Okay, So our cost on this would be $1.50. Now, the beautiful thing with vertical spreads like this is when we pay for them, we know, thank you, Anand, I got you. We know that is our maximum risk. Okay. We could never lose more than that. Okay. And Alan, got you. Way to go, Kim. Okay. So that is our risk. Now, how much can we make off of that? We know what our risk is. How much can we make off of that? In this particular spread, guys, what is the maximum value of this spread? So if MSTR were to go down and at expiration be at the lowest strike that we have here or lower, which is 148, what is the maximum value of this spread? Anybody know? Should. There we go. Perfect, Robert. Maximum value is the difference between the strikes, or $6. Okay, does everybody understand that? Okay, Anand, it's not 3.5. The maximum value is $6. 154 minus 148. Now, the maximum profit or the maximum reward would then be 6 minus our investment, or $4.50. Okay, that would be our maximum reward. Tommy, not 375, it would be 450. Okay, the spread can be worth 6 if I've invested or paid $1.50 for it, which is my maximum loss. Then if this thing maxed out, we could make $4.50. Okay, does that make sense? Okay, Bob, nice. Okay, does that logic, does that math, does that concept work for everybody? Okay, good. So now we have calculated the max. Uh, that wasn't a trade, everybody, by the way, if you can see what's going on here. That was not a trade. That was someone falling off a chair that they all rooted for the guy's demise. That's what happens here in when things are a little bit slower. So that wasn't a trade if you saw all the hubbub back here. Anyway, back to our math. Okay. The maximum potential we could make is $4.50. And this is great. Now you actually get a real insight into what happens in the trading pit here. This is classic. This is classic. So the max we could make is 450. The max we could lose, which was our debit, what we pay is $1.50. Okay, what's 450 divided by 350? That's 3 to 1. That's 3 to 1. That means for every dollar I invest, I could make $3. Excuse me. It's 3 to 1 reward to risk. Okay. A few minutes ago, we talked about, what is the reward to risk that we want to look for? And in just a plain vertical spread like this, we want to look typically for 2.5 to 1 or better. This is 3 to 1. Okay. Great. Not that I would put this exact spread on, but I know that if I wanted to, if I'm bearish, given what the expected move is, great. This is going to afford me the reward to risk, and I would put this on. Now, maybe I adjust the strikes a little bit here, but I would definitely look at considering this put spread. Okay, and when we when we calculate spreads and signals to put out to all of you, this is really the process that we are going through. Now, I've made it a little bit more basic than what we are looking at. Okay, but this is really, if you're going to look at doing something on your own, I highly suggest you follow this protocol, this regimen. Okay. All right, everybody. that is a wrap for the day here. Okay, and you know what time it is? It is time to bring in our wheel. All right, so let me bring that right onto the screen here for everybody. Here we go. We're going to make that large. Everybody can see that now. And let's spin the wheel for swag, guys. There we go. What's that? Oh, there we go. 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 Oh, man, Robert, didn't you win yesterday? Didn't you win yesterday, Robert? And if you did, that's fine. You can win again, but I'm going to spin it again because I want to have someone else in here. Okay, Robert, give me an answer here real quick, man. I think you did. Regardless, day before yesterday. Okay, I'm old. My mind does everything together here. Let's do it again. Here we go, guys. Robert, you're in again. You'll get a different piece of swag. One more for today. And then, Mike, let's get the link for tomorrow, Webby, on there. Oh, my God, this is crazy. This is not rigged, folks. Kim, you won early in the week. So now we're going to spin again, guys. Now we're going to spin again. Kim, you got another something coming to you. We're going to remove Kim off of this one. Here we go. One more for the day. Short strikers. There we go. And who is it? Buffalo. Buffalo, I don't know your real name. I saw that's how you entered in here. Okay. So Buffalo and Robert and Kim, if you can do this. Okay. If you can do this, please email us. Yeah, Tom, I didn't know if that last tick was going to be on your name or not. Email us your mailing address. Email us the size that you want. Okay, to this email address right here. You got it, Mike? Okay, I got it. There we go. Okay, email us there. And Buffalo, in your case, please give us your name too, since I don't know your name. Okay. All right, guys. One last thing for today. One last thing for today. I am doing a webinar tomorrow morning. Yes, tomorrow morning. It's Saturday. It's 9 o'clock in the morning. You'll be done by 10:30. You can go on to your weekend. If anybody is interested in signing up in my webinar tomorrow morning, okay, there should be a link in the chat here coming up. There it is. Okay, 9 o'clock tomorrow morning. That'll be me live. And then I promise you we'll be done by 10:30 because I have an 11:30 tea time. So I promise. I promise. All right, guys. Thank you for tuning in today. Everybody, John Pro V1, you too. Have a great weekend, everybody. And we'll see you back on Monday or hopefully tomorrow morning. Ciao, everybody.